This is Nightly Business Report with Bill Griffith and Sue Herrera.
Deal or no deal? Mixed messages from the White House on a trade agreement with China keep investors guessing and send stocks all over the place.
America gets a raise. Wage growth accelerates at its fastest pace in nearly a decade. Now it's the Fed's turn.
Shipping and handling. No one ever said logistics was sexy, but it is lucrative for one entrepreneur who had the bright idea to ship packages at a lower cost around the world. Those stories and much more tonight on Nightly Business Report for Friday, November 2nd.
And we do bid you good evening, everybody, and welcome. You know, when the White House speaks on trade, the market listens, and that's exactly what happened today. However, mixed signals from the president and his top economic advisor caused the Dow to zig and zag all day. Stocks were sharply higher overnight on a Bloomberg report that said President Trump had asked officials to prepare a draft for a U.S.-China trade deal. But at midday, a White House advisor threw cold water on that.
There's no massive movement to deal with trade. We're doing a normal, routine run-through of things that we've already put together and normal preparation, okay? There's no mass movement. There's no huge thing. We're not on the cusp of a deal.
And stocks fell sharply on that comment, only to reverse course a short time later when the president said the two countries are getting closer.
We've had very good discussions with China. We're getting much closer to doing something. They very much want to make a deal. I think we'll make a deal with China, and I think it'll be a very fair deal for everybody, but it will be a good deal for the United States.
And that lifted stocks off their lows. When it all said and done, the Dow was down 109 points. It had been down as many as 300 points at the lows of the day. The Nasdaq fell by 77. The S&P 500 slipped by 17. Now, in addition to the confusing trade comments, Wall Street also had to deal with a sharp decline in Apple shares and a strong jobs report that showed accelerating wage growth. It all added up to a head-spinning day. And Bob Pisani witnessed it all from the New York Stock Exchange.
We had an early morning rally that quickly faded on this Friday. The Dow, the S&P, and the Nasdaq all snapping three-day win streaks. So what happened? Investors were focused on three key drivers of sentiment: trade wars, the jobs report, and Apple. First, the markets got an early lift from high hopes that trade talks between President Donald Trump and Chinese President Xi Jinping were going well. And there were even reports of a possible deal being drawn up. But all that action fizzled out after several White House officials, including top economic advisor Larry Kudlow, said there was no imminent deal with the Chinese government. But then the markets lifted off their lows late in the day when the president himself said they were getting closer to a deal. So which is it? We don't know. Add to that a strong jobs report, which showed wages grew at their fastest pace in 9 years, up 3.1% year over year. That sent bond yields spiking and fueled further worries about a more aggressive Federal Reserve. Wages rising at a faster clip means the Fed might get boxed in and forced to raise rates in December and perhaps more than 2 or 3 times next year. Tech led the losses in a big way today, of course, thanks to Apple. Apple tumbled about 7% after earnings beat, but iPhone shipments missed the mark, and the company said it would no longer break out product sales for its iPhones, iPads, or MacBooks. Now, that marks a major change in its reporting structure as Apple transitions from being a big hardware player to more of a services business. Now, that really led to a mega cap decline in tech, as I call it. Not only Apple, but also Microsoft, Amazon, Facebook, and Google parent Alphabet all tumbling on the day. Keep in mind, these 5 mega cap stocks make up about half of the NASDAQ 100. That's how big they are. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
And as Bob just mentioned, it is payday in America. Not only did the job market heat up last month, but wage growth accelerated after years of stagnant paychecks. The economy added 250,000 jobs, easily exceeding the expectations. The unemployment rate held steady at 3.7%. That is a 49-year low. Wages were the big story. Year over year, they rose 3.1%, the biggest annual gain for average hourly earnings since 2009. And the labor force participation rate rose to 62.9%. And October marked the 97th consecutive month of job growth, extending an already record-breaking streak.
Well, let's turn now to Anthony Chan for more analysis on this very strong jobs report. He's chief economist at Chase. Always good to see you, Anthony. Thanks for joining us tonight.
Good to see you, Bill.
Is this what a Goldilocks economy looks like? Is that what we're describing here?
Well, I think it's encouraging because we're starting to see wages picking up, and that's exactly what we wanted to do for quite some time. Now, I know there's concern whether there's inflation, but when you look at the data, what I find is that there is a relationship between the changes in the unemployment rate and average hourly earnings. And so as you lower the unemployment rate, of course, wages pick up a little bit. But that relationship is much, much weaker when you look at changes in the unemployment rate and the overall inflation rate. And that's what matters to the Federal Reserve.
And I was just going to say, what does this mean to the Federal Reserve? Does it box them into another rate hike in December, or do you think the economy is chugging along just fine with only moderate inflation?
I think that everything that the Federal Reserve has been doing has been getting the job done. They've raised interest rates 8 times, and I think they will continue to raise rates once per quarter. There's nothing in this report that says that they should deviate from that path, and I think that in December they will raise rates one more time and continue well into 2019.
Along those lines, Larry Kudlow said today that he feels this is a growth economy with low inflation. And Ed Lazier, it's interesting, today, he used to chair George W. Bush's Council of Economic Advisors. He sort of did the math along those lines on whether or not there is inflation in this economy. Take a listen.
The Fed has this notion of a target rate of about 2%. Whether you like that or not, that's their target rate. So if you said, well, 2% added to 2.5% productivity growth, we would be then saying, gee, we could afford 4.5% wage growth and still not be putting upward pressure on prices beyond that which the Fed would allow.
And that's the ammo some would use to say that the Fed shouldn't be so aggressive in raising rates in the future. What do you think?
Well, I think the Fed hasn't been aggressive at all. And in fact, you did see in the latest calendar quarter productivity growth in excess of 2%. But one of the things you should notice is that we saw that business investment in the third quarter went down. So I don't see any reason why we're going to see productivity growth in excess of 2% going into 2019. If we continue to get 2 or 3% productivity growth, I'd be the first person online to say that there is no concern whatsoever. But I don't really see productivity being that strong, especially if we start to see business investment slowing down and economic growth slowing down. When those two things happen, historically you see productivity slowing down. And that's what the Federal Reserve is trying to protect against the possibility of inflation. Last point on that, remember that what the Federal Reserve does today influences or impacts the economy about 18 months into the future. So what they're doing today is trying to protect us from something in the future.
Very good. Anthony Chan with Chase. Always good to see you. Thanks again for joining us.
My pleasure.
Well, the October employment report is the last major economic report before the midterm elections. And the economy may play an unusual role when entering the voting booth next week. Elon Mui explains.
America's job market is on fire. 250,000 jobs were created last month. The unemployment rate stayed at just 3.7%, the lowest level in nearly 50 years. And that has voters in Maryland feeling pretty happy with the economy.
I think the economy is good right now, and it's certainly moving in the right track.
Every major sector of the economy added jobs last month. Manufacturing was up 32,000 jobs. Transportation gained 25,000 jobs. And leisure and hospitality increased by 42,000 jobs. But will these numbers help Republicans in next week's midterm elections? A recent poll by NBC and the Wall Street Journal found that voters believe the GOP is better at managing the economy than Democrats. The president touted the jobs report on his way to a rally in West Virginia and tweeted that the numbers are incredible. Keep it going, vote Republican.
If you have a Republican sweep, I think you may get much more stimulus. If you have divided government, which is the norm really since the 1940s, you will get a little bit more of a blocking of the president's agenda, maybe less stimulus going into 2020. So I think a lot more sugar if we get Republican victory on Tuesday.
But if you think these numbers are a slam dunk for Republicans, think again. The president's party typically loses seats in the midterms, and one new analysis shows the losses are actually bigger as the unemployment rate falls. Many political pundits predict that Democrats will take control of the House, And economist Heidi Shierholz pointed out the jobless rate has been falling for a while.
By the time President Obama left office, it was 4.8%. It has continued declining since then. It's now 3.7%, and that's fantastic for workers. And the key thing to remember, however, is that no sitting president gets to take credit for just not messing up an existing positive trend.
At a polling station in Silver Spring, Maryland, voters we talked to were torn.
I feel like they are both equally responsible because economic trends play out over really long timelines. And so it's sort of a combined party effort, if you ask me.
I don't think it's either or. I think it's working together to make things work out for the community and the people.
With just a few days left to go before the election, both parties claim they hold the key to a strong economy. For Nightly Business Report, I'm Ilan Mui in Washington.
Now to Apple and that sharp decline in the stock that we mentioned earlier today. A number of analysts expressed their concern over the company's new reporting structure that will no longer break out sales figures by product category. Jeffrey said that decision is, quote, fueling fears that the company has something to hide. Nomura said, quote, it raises the specter of a sustained iPhone downturn. And Bank of America Merrill Lynch said it expects to see additional negative estimate revisions. Well, that sent the stock down more than 6.5% today, making it the worst performing stock in the Dow.
The two best performing Dow stocks today were Exxon and Chevron. Those companies blew past earnings estimates and, thanks to higher oil prices, both delivered their strongest third quarter results in 4 years. Investors were pleased, sending the stocks higher in trading today. But those rising oil prices that helped deliver a strong quarter are also leaving behind a lot of questions. Jackie DeAngelis has more.
Profits are surging at America's biggest oil companies. Exxon and Chevron were able to ride the wave of higher oil prices and better refining margins. Exxon's oil and natural gas output surpassed expectations for the first time in 10 quarters. Chevron's profits doubled thanks to record production and a sharp increase in output from the red-hot Permian Basin. That strong production helped both companies crank out cash, their strongest quarter for cash generation since the slump in crude prices back in 2014. Oil prices were in the mid-70s in October because of supply and demand. They were stabilizing, and many thought the premium was warranted since the Iranians were likely to export less come U.S. sanction time, set to go into effect in 2 days. But more recently, there's been a change in tone. Oil prices have fallen dramatically, about 15% over the past month. The new thinking is that Iranian exports may not fall as fast as expected. Add to that stock market uncertainty and the potential for slowing demand, and oil is now in the low 60s. That could set off a chain reaction within the industry. Lower oil prices mean companies like Exxon and Chevron will produce less, reversing the surge in production that we saw in the most recent quarter that led to much stronger than expected results, because drilling can't continue if it becomes less profitable. And as go oil prices, so may future quarters for Exxon and Chevron. For Nightly Business Report, I'm Jackie DeAngelis.
Time to take a look now at some of today's upgrades and downgrades. We begin with shares of UPS tonight. That was downgraded to neutral from buy at Citi. The analyst cites the potential for a new round of tariffs in January, which could hurt the volumes in the first half of next year. Price target now $115, the lowest on Wall Street, by the way. That stock fell more than 1% to $105.99. Kraft Heinz was downgraded to negative from neutral at Susquehanna. The analyst cited less confidence in management and said downward earnings revisions are likely. The price target now $47. The stock fell by 9% today to $50.73. And Michael Kors was upgraded to buy from neutral at UBS. The analyst cited the company's strong brands. Price target $80. That stock rose 1.5% today to $58.29.
Still ahead, help wanted. The construction industry is booming, but where are all of the builders?
The construction industry added 30,000 jobs last month. That was one of the biggest drivers of that strong employment report. But even with the latest gains, the industry is still facing labor shortages with thousands of positions left unfilled. Kate Rogers is in Baltimore for us tonight.
The construction industry is booming, adding some 330,000 jobs this year alone. But experts say there are still nearly 500,000 open jobs waiting to be filled. These big numbers mean big opportunities for Baltimore's Eugene Jowers.
What's going on, man?
After completing a local program called Project Jumpstart that trains and places Baltimore residents in construction jobs, Jowers works in a job he enjoys that pays well.
It gives you job skills and training that you can start getting paid at a higher level. So my pay is, I get paid a good enough amount to where I can provide for my family and still have a little pocket change to, run around.
The industry is attempting to find more employees like Jowers, letting workers with and without college degrees know that jobs are available and careers can be promising.
You come into our industry, the beautiful thing is we will teach you the trade that you want to learn, and we will pay you while you do that. And when you graduate from that competency-based or time-based apprenticeship program, you'll be making a great living.
But a skilled worker shortage is hitting home for small business owner Larry Lopez. His company, Green Job Works in Baltimore, needs 20 skilled workers, a challenge for any employer in an increasingly tight labor market. Lopez is trying to attract talent with benefits like paid time off and health insurance. His workers are also employees, not contractors.
How can you deliver for a customer if you do not, take ownership to the people that work for you? It's critical if we want to be successful in our industry.
In this employees market, Jowers is 2 years in with an eye to his future.
Since I've been in construction, I think I want to be a superintendent. I think I like running the sites.
Building a future in an industry looking for workers. For Nightly Business Report, I'm Kate Rogers in Baltimore.
Alibaba blames an uncertain economy for its weak outlook, and that's where we begin tonight's market focus. The Chinese e-commerce company cut its full-year revenue forecast. Alibaba says the trade war and slowing economy could hit sales of consumer durable goods, but that other services will be affected not quite as much. So shares of Alibaba fell about 2% to 147.59. Newell Brands topped profit expectations and raised its full-year outlook. The maker of Sharpies and Elmer's glue said it was able to offset the cost of tariffs by returning production of some goods back to the U.S. It negotiated exemptions and also it raised prices. Shares rose more than 14% to $18.99.
VeriSign has entered into an agreement with the Department of Commerce that allows that company to increase wholesale prices for .com domain names. That pricing power has sent the stock to an 18-year high. Shares popped by 17% to 165.02 today. And Walmart has filed a lawsuit against Synchrony Financial. They did that late last night, alleging breach of contract. Synchrony was Walmart's exclusive credit card issuer for the last 20 years until the retailer replaced them with Capital One over the summer. In this new lawsuit, Walmart alleges that Synchrony's underwriting standards caused Walmart financial harm, and it is seeking $800 million in damages. Synchrony calls the complaint baseless. Synchrony shares fell more than 9% today to 26.43. Shares of Walmart rose a fraction to 101.34.
And now to our market monitor, who likes dividend-paying stocks that he says should benefit from consumer spending. The last time he was on in April, he recommended 3 ETFs. The S&P Aerospace and Defense ETF, which is up 2%, the SPDR S&P Capital Market ETF, which is down 10%, and the iShares North America Tech Software ETF, which is 7% higher. Joining us is Mark Lucchini. He's the investment strategist at Janney Montgomery Scott. Good to see you again, Mark. Welcome back.
Thanks, Sue.
Let's start with your first one, Carnival, as in the cruise line. It has a pretty nice yield.
It does. It has above a 3-handle yield, which I think is still pretty appealing, that is, even as we've seen this bump in interest rates of recently, but particularly when compared to the S&P 500 at less than 2%. And it's benefiting from flows of traffic. Both baby boomers and millennials that are flush with cash are seeing wages increasing, like you've talked about in most of your segment here today, and are looking for experiences and chances to get away from the hustle and bustle. And Carnival is, I think, a good name with a healthy dividend, and I think in a good position to take advantage of that.
Tapestry, the old, used to be called Coach, of course. I haven't often thought of it as a dividend play, but it has a 3% yield right now, and it had an up and down year in the stock market as well. Why do you like it here?
Well, Bill, of course, it's a discretionary stock, and that space has been buffeted by a bunch of different issues over the course of the year. But the fact of the matter is it's an aspirational purchase brand in the form of Coach. Recently bought Versace to continue to build out its portfolio of offerings. And again, I think because the consumer continues to win by way of seeing wage gains, they have confidence in their jobs, feel good about what the future looks like through confidence surveys, all leads me to believe that consumption is going to remain a positive impulse for the U.S. economy, and they're going to stand to benefit from that same thesis.
And I would assume, if that is correct, that our next pick, Walmart, would do the same.
Yeah, besides the prospective windfall from their lawsuit that you just talked about, I still think, of course, they're a retail giant, general merchandiser, competing very effectively, by the way, against Amazon by way of their e-commerce initiative, which is big and fast growing, and therefore I think, again, is well positioned to address the consumer needs from those affluent to less affluent alike.
On that note, Mark, thank you so much. Mark Lucchini with Janney Montgomery Scott. And as always, to read more about Mark's picks, you can head to our website, which is nbr.com.
Coming up, one entrepreneur's bright idea that led to fulfillment for his customers and for himself. Toyota is recalling more than 1 million vehicles on concerns that the airbags may inflate without a crash or fail to work if there's an accident. In the U.S., that recall applies to about 17,000 Scion XA car models in the year for model years 2004 through 2006. Additional models have been recalled in Japan and in Europe.
Do you ever wonder where all that stuff that you buy online is kept or how it gets shipped? A lot of companies get help by outsourcing. With an e-commerce boom driving growth, third-party logistics is worth almost $200 billion in the U.S. alone. And that is why one entrepreneur from New York City got the bright idea to help other companies make sure their products get from here to there.
Raphael Zakhanov began selling high-end surplus watches and jewelry as he worked his way through college in 2009. He discounted prices and sold online through Amazon, eBay, and others out of an apartment in Queens.
The living room was a warehouse, and the bedroom was a warehouse.
As he filled up the apartment with 10,000 items, Zakhanov began to notice price differences between the Amazons and eBays, telling friends and family running similar businesses that they often paid too much.
I saw that they're really missing an opportunity of selling elsewhere where the margins were better. None of them wanted to handle the logistics, or the space was too expensive.
A burgeoning e-commerce boom meant thousands of small businesses needed help with storage, packaging, labeling, and shipping.
I started calling up friends and I was like, hey, instead of you sending everything to Amazon, send me it. I'll send half to Amazon. We'll keep half of it by us and we'll pick, pack, and ship it as the orders come in.
Starting in 2011, his company, Ruby Has Fulfillment, outgrew the apartment and then an office space and a warehouse. By 2014, it was handling a couple thousand orders a day, and Ruby took its conveyor systems and shelving to a warehouse on Long Island. On average, the company says customers save 45% on freight, and if you think Ruby's warehouse looks like an Amazon fulfillment center, well, that's no accident.
We had to do everything right, and we had to do it the way Amazon would do it, just on a much smaller scale. We have clients today that have distribution centers 10 times our size, where that distribution center cannot handle the direct-to-consumer needs.
In fact, Ruby handles some orders from Amazon, but one thing Ruby offers that Amazon doesn't is the ability to use a customer's branded packaging.
There's a lot of companies that can say that they can do the branding, but not in scale, right? As soon as you start doing 1,000 orders a day, what we see is they break down on scale.
I don't want it to be like a third-party brand.
Chris Wichert started his high-end sneaker brand Koyo in a Brooklyn, New York apartment 3 years ago. Now Koyo has stores in New York, Chicago, and Los Angeles, but 60% of its business happens online. When Wichert signed on with Ruby this year, they realized some of his inventory lacked the barcodes needed for automated processing.
They discovered the problem, and without just like sending them back or ignoring the problem, they would print barcodes themselves and label them and get them into the system so that nothing is lost.
Now with almost 200 clients and revenue of more than $17 million a year, Ruby has added warehouses in Las Vegas and New Jersey, with plans to expand further in 2019, aiming to keep delivery times down to the 2 to 3 days consumers expect and businesses depend on.
You could literally deploy those dollars into product, marketing, staffing, right? Things that actually help them grow the business. Getting a new forklift isn't going to add their top line or to the bottom line.
And Ruby now has more than 200 employees and is looking to expand not only here at home, but internationally, possibly into Canada and Europe in the near future.
One more look at the day on Wall Street, kind of a mixed day. The Dow down 109 points, was down 300. NASDAQ fell 77. The S&P was down 17.
And that will do it for us tonight on Nightly Business Report. I'm Sue Herrera. Thanks for watching.
I'm Bill Griffith. Have a great weekend, everybody. We'll see you Monday.